Hey, how you doing,
Hey,
Albert?
how you doing, Mr. Grider? Good morning.
Doing great. I was thinking about this year and how things going, and I had some webinars at the beginning of this year of how the NBA forecast look and how the volume's going to do. And I pulled up the last NBA mortgage finance forecast, right? This was done October 27, and this year, they're saying we're going to do about just under 1.8 trillion. 2023, 1.5 trillion for our mortgage industry, which is really low.
Hmm.
And I started looking at the rate forecast because I was looking at the beginning of the year. I thought rates would go down a little bit further, quicker than they did.
Sure.
And then the NBA forecast says, hey, rates conforming in Q4 of this year are going to be about 6.3 with the 10-year treasury yield at 4. And then I looked today at the reports and it's like, hey, the 30 years probably mortgage rates closer to 7 and the 10 years running about 4.4. So when we look at these forecasts and we're going through this, it's interesting, but we still got a plan. The good news, 2025 looks pretty good, where they're, a pretty decent increase to get to 2.3 trillion and then up from there. Because mortgage industry guys volatile. It's just volatile. It's like rates
Sure.
go down, lots of volume, then rates go up, slows down, but it's very need based as well. People need to buy homes or families move, jobs that need cash out. And so that's why I thought we'd be talking about DSCR. And because that's been a lot of webinars on that, and I get that. So thank you all for joining here. And I think we should kind of begin here and kind of see why we're talking about this, and as
Yeah,
we set up
absolutely.
ourselves for the holiday season.
Yeah, some great talking points here, Mr. Grider, and thank you for sharing that information with us. So, welcome everyone. Glad to have you here with us with another Home Express webinar. Today, we're going to be talking about discovering DSCR. As always, we want to thank you for your participation. So here's some of the things that we're going to be covering today. Obviously, this is going to be very informative in nature, purely with the DSCR program. We have a lot of great information to share with you. As always, our presenters, Mr. Grider, who's our Senior Vice President of Wholesale Lending, myself, Albert Martinez, and I'm the Corporate Trainer here at Home Express. And our special guest today is Mr. Art Hickson, who is our Vice President of Sales in the Eastern Division. So with that, I'd like to hand it off to you, Mr. Grider.
Oh, great.
Thank you,
Thanks,
Albert.
Albert. And so as we begin, this kind of discover DSCR, and we want to do this because I looked at a lot of our business partners that have adopted, hey, different channels for loans than the normal conventional lending. The FHA, the bank, even the bank statements. I have to really kind of look at this, at why this product has been done well for them and how that's really kept and expanded their loans, able to close more loans and retain more of those customers and partners with real estate agents. But so we're going to go ahead and begin on this. I don't know if Albert, we have something, a poll for everybody to
You
kind
know,
of
Mr.
start us out.
Grider,
You do
I
have
have
one. Okay.
I do, Mr.
All
Grider. You
right.
know, I always do. I come prepared, and as a matter of fact, we are in November, and Thanksgiving is my favorite holiday of the year. And with that, I'd like to ask the masses what they think. What do you think, Mr. Grider? Should we ask the masses
Yeah,
what they think?
let's find out. It's the holiday spirits
Absolutely,
here, so I'm already geared up for that.
absolutely. Okay, so here we go. So the question is, what is the best way to cook a Thanksgiving turkey? Is it roasted? Is it fried? Is it smoked? Or hey, I just skip straight to the ham.
Oh wow, this is
So
a good one. I'm gonna go traditional. It's gonna be a turkey, right? And then I think roast is gonna be on the number one, but I last few years I've done it on the smoker, and good reason for that using the smoker. That's outside. The oven's freed for all the other stuff that you have for Thanksgiving. So
you
I'm gonna
know,
go
but
roasted.
I will have to say that nothing beats the smell of walking in the living room and the house smells when the
That's
turkey is going.
true.
So with that, hey, the masses have spoken. It's right, Miss Roasted, Mr. Grider. That's what
I,
everybody likes.
Oh yeah, that's how my grandma used to do it as a kid, right? I'm older. Is that you go over there for Thanksgiving dinner, it smells so good, right? So awesome. So I hope everybody has a great Thanksgiving coming at the end of this month and as we wrap up this year. So let's kind of begin, kind of go through DSCR again and really the business purpose. And so couple of things here we're doing is just kind of refresher for those. I know there's lots of webinars, a lot of people have been doing this, but if you haven't, please kind of look at these different avenues for you to close more loans. So DSCR stands for debt service coverage ratio, and the qualifications are unique, meaning we're not going through traditional ways of income, even though you can do loans on income based on business purpose, but most of the time it's done based off the credit profile of the borrower and the cash flow of the property. It truly is just, it's a business, it's a income producing property, and that's how it's kind of set, and it kind of goes from there. It's very expansive on property types, right? SFR, condos, units, short-term rentals, condo hotels, non-warrantable condos, right? Those things, and opened up to a lot of citizenship types. And with many, as you see on this, we're allowed to invest in a business entity, and we have a lot of that done today. And you kind of go, why do they want to do that? Well, they like to take on their business and their invest properties, take away some liability on person, slip and fall off their rental, those types of things. So if they put it into vesting into a business entity, it's kind of separate from them. And we see that all the time, and able to do that in-house for you. We are a true lender. It means we underwrite our own guidelines, fund with our own money. And so we're able to do everything in-house for you for this on these loans. Let's go to the next, and we'll kind of just go through this a little bit. So we talked a little bit about what DSCR, right, is, and how it qualifies. And I've got another example for you, just how that math works for you. On a purchase, you use the 1007 or 1025. These are just rent surveys, right? 1007 says for SFR condo, 1025 is 2 to 4 units, right? On a refinance, you can use either one, right? And, so we kind of have a mantra of speed, ease, convenience. So we really try to keep the conditions and guidelines easy to use and pertinent just to that transaction to make it easier for you and your borrower to close it more quickly. And so on a refinance, we look at the rent survey. The rent survey will also have actual on there and market rents on there, but we can use the actual if it's higher, and we can get proof of that. So that can help you on that DSCR percentage, right? Again, we talked about property types, and the calculation is kind of a little different from a long-term rent and a short-term rental, right? So it's 1-to-1 if it's a long-term rental. That's it. There's no real vacancy or expense factor on a DSCR loan. There is if you're doing income on that. But on short-term rentals, even if it's not an income file, we apply a 20% expense vacancy factor. And it's everybody asks me, well, why? We shouldn't. Well, the real is like on long-term rents, normally the utilities are paid by the tenant and the day-to-day up. When you're short-term rental and somebody's renting it out for a shorter amount of days, the utilities are paid by the owner, and there's a little more upkeep and costs for housekeeping and those type of things, activities. And so we take into account an expense vacancy factor for that. And again, as always, you can do income documentation on that. So all doc works, we can do business bank statements, so it takes that calculation away and you just qualify off the income. We'll go to the next slide and talk a little bit some examples. And again, you don't have to write all these down. We're going to send everybody registered a copy of this deck. And please, as we're going through this, if you got questions on anything on the industry, product related, those type of things, put them in the chat and we'll address those at the end. So here's the calculations for like a long-term rent here, right? So you have a rent payment of coming in of $2,000, your PITIA is $1,900, you're over one, just to divide those out. And you can see where that will get you to the max LTV and a better rate. There's actually a rate reduction the higher if you get above 1.25 as well, where you have more coverage on that. Also, another example, what if the rent payment used to qualify is $2,000, but your PITIA is above that? That shows the DSCR below 1. Now, with that, usually just normally a little bit more riskier. So you have a rate ad for that or a price ad and LTV restrictions on those, right? Then another example we'll give you on the short-term rentals. The key for short-term rentals for me is to make sure that it's a property that's in a higher density of short-term rentals. You're talking resort areas, typically where the higher percentage. And we normally require some type of air DNA or something that kind of proves that. And if it's a refinance, a 12-month history. Because we know that different times of the year, those those rents for those 2 to 5 days, whatever they stay there, are higher at certain times of the year. That's seasonality. Like if it's a resort area in Colorado for ski season, winter months they get more than the summer. Likewise, on the beach type of resort areas, they get more in the summer, less in the winter. So you just need to average those out. So you just take the 12 months, add up the sum of the 12 months, divide by 12, and then you take your expense factor for that calculation. We'll go to the next slide here, Albert. Some of the highlights. These are just some highlights. So if you have questions, I mean, I had an AE in the class, with Albert maybe a couple months ago, and because we believe in training, we train our AEs for 2 weeks before they hit the field, and they have ongoing training weekly. But he made this comment. I thought it was funny, but it's kind of true. It's if the loan doesn't fit, don't quit, right? So, and I really mean that. What that means is if you're struggling with a loan, trying to get through traditional underwriting, call one of our AEs up. They're going to help you structure these deals to let you know how we can get that deal done, and it'll surprise you how many deals we can do that you might not have thought about. So on these highlights, I'll cover a little bit of this, right? Borrower can own unlimited properties. There's no limit on that. We do limit the number of loans we do per borrower to 10 at a time, up to a 4 million aggregate. So it kind of widens it out, right? Of like, wow, this borrower I had owned 12 properties. I couldn't get it through traditional financing. You can come into the non-QM. These are non-TRID. These are truly business purpose. You don't have the same regulations. So there's no rescission periods, no LECD. We do send out terms of the loan because we try to be transparent. So what they're getting, they know what they're getting when they sign, right? You can order the appraisal at any time. And I recommend that's probably the number one underwriting condition, because when you're especially doing a purchase, you don't know what the rent survey is going to be. So try to get that when you order an appraisal on one of these investment properties, some more data. The more data you have on what the rents are that you can provide them, because most of the appraisers have, they go to the MLS, and there's a lot of data that's not on the MLS where investors advertise their rentals in different sources. So the more you have on that, and on our portal, with our technology, we do have a rental meter, a retometer, if you call that. And if you put in the property address, the bed and bath count, and in an email within, a couple minutes, you get back for kind of some estimates of rentals. So we try to help you out with that. Dual comps allowed since it's business purpose. So you can make up to 5 points. Again, I caution you, cash out refinances got to be used for business purpose. If not, that's 50% plus $1 got to be business purpose. If not, then you got to afford TRID and then to go into a consumer purpose loan. We do have DSCRs that even go below 0.75 with reduced LTVs. Minimum FICO to get in is 620. Talked about the business entity. And the good news is, I've seen this come over. I'm glad we've had this on several webinars, that you're not stuck to the state that you're licensed in NMLS. There's other states that do not require you to be NMLS licensed in and able to originate this business. And I think that's on our next slide, Albert, of that. Right. So everything that's in the dark colors here are states that do not require the originator to be NMLS licensed. So you could be a loan officer in California with clients looking for expanding their real estate portfolio, right? Because most of these investors we get in, they kind of understand it's like American real estate, there is a whole shortage here. You can say, well, we kind of crush demand with rates and taxes and insurance, but there's still a shortage. People would like to buy homes. And so they're looking at areas maybe where that rents will cover that their mortgage, that mortgage payment on that, so we have some cash flow with it. And sometimes they have to go to other areas that to get that, whether it be Texas, Florida, that Midwest type of areas. We've seen a lot of that where the clients say, great, they usually get help out with the property manager that they have in that area to increase their portfolio. So it's not just all in stocks, bonds, or gold or crypto. I don't know, whatever their strategy is, but normally there's a percentage of that's in real estate. All right, we'll go to the next slide, Albert. Okay, I wanted to talk about consumer purpose because, there's a lot of loans out there where you're going to get, and I've had this come up and say, hey, is this borrower wants to do a refinance their investment property, and this cash out that they want is to buy a new primary. I'm going, okay, well, that doesn't fit business purpose because that's a consumer purpose loan, right? And so we're able to do those to help you out, but we're going to afford TRID on those. So if the purpose for a consumer, then we got to afford TRID, which we have that capability. So don't say no to those or try to say, hey, well, it's going to be for business purpose. No, if it's for consumer purpose, we have an avenue for you, right? And we have almost all the doc types available for you, bank statements. You don't need tax returns for that. If and again, we do see some full doc stuff come in because our pricing is really competitive with agency on these, right? But as you know, we do, if you do an income file, we're going to do the standard net rents using a 20% expense factor. And there's an example of the math here. We'll go to the next slide, Albert. And we talked about expanding programs beginning of the year, and I thought I'd talk about condos because we've had a few of these deals come in, so it's kind of a refresher. Saying expanding because it came out about the last year or so. There's some kind of that's kind of really expanded. And the big thing though is what's a condotel? Well, these are actually the short-term rentals in the name by definition, right? But each individual unit is owned by a person. It's not everybody, it's not owned by a company and that. These are individual condos that they have a management desk down below for that rentals. And there's some qualifications on this, but you can do these as owner occupied second homes or non-owners, right? Short-term, depends on the usage of that, right? And we can do some high rise. And again, if you're high rise in certain areas, might have a little, some more documentation on the HOA we'd need, especially in Florida, right? With some of the regulations that come out. So it's just going to give you more avenues to close more loans. So let's go to the next slide here, Albert.
Hey, Mr.
Oh,
Ryder, before we actually get into this slide,
okay.
you're bringing up all this useful information about DSCR. We're talking about the MBA and the predictions, and I'm just curious to what the masses think about the DSCR production of of the industry as a whole. What do you think, Mr. Ryder? Should we ask the
I
masses
think,
as a
yeah.
whole?
Yeah,
All
there's got
right.
to be a reason we're talking about this, right? So let's figure out what kind of volume percentage we have out
Here we
here.
go.
Here we
So
go.
2024, DSCR accounted for what percentage of overall non-QM production? Obviously, we're talking about units and now talking about dollars. So what say you?
I think it's going to be in the middle there. 50% would be the poll number on units, right? 50%. That's what I think everybody's going to guess.
So overall, the unit production,
Overall,
you think about
50% of
half
the
of it
units.
was
Yeah.
so half of it you think was probably bank statement and the other half being DSCR,
Yeah.
correct?
Yep.
Okay. Okay. Well, it seems like the masses like to think that it's 60%, Mr.
Man,
Grider.
we got some sharp
60%.
people. It is. I mean, if you look at the opportunities out there and those that are looking for opportunity, it is that. So good. So if this is not, when I say discover DSCR, I think a lot of you have, and you kind of put that into your portfolio mix and part of your strategy for this year. And again, for 2025, I think it's going to be the same. I really do. This is going to be a big percentage of the non-QM business. So with that, I'm like to have Art come on and kind of talk about some examples that we've done and to kind of give you some real deals that have closed here. Maybe help you kind of think of ways of why people do this and how they get done. So Art, you want to share some examples for us?
Thank you, David. I think it's always great to go through a few tombstones or recently closed loans to, it might spark, someone may have one of these laying on their desk to do. But the first one we're going to go through is a long-term rental. This is a 3-unit in Los Angeles. You can see the rents came in at about $4,800. You take the PITIA, if there's an association, of 3,300, and you come up with a DSCR of 1.4. Very strong property already, but that's with a 30% down. And this deal I looked at it, I go, man, it's fantastic, especially for Los Angeles, usually where the rents are a little lower on the purchase price, but there's a real opportunity for this investor because they can, it looks like the market rents were a little low according to the appraiser's notes. So he can go in, do a little rehab work, and maybe increase the rents a bit, and he's going to have a great investment property going forward. With a 1-year prepay, at that point, he can either refinance or he can just stick with the loan, and he'll have a nice return right out of the gate, money in his pocket every month versus just waiting for appreciation. So it's a great loan. I just want to remind everyone that to get your income on this, I highly recommend when you see a deal like this, you talk to the account executives and come up with the right formula to best help the borrower. You can use the 1007 right out of the appraisal, or in certain cases, you want to use actual rents. So that would be just getting the lease agreement with 6 months remaining, and then just show evidence of the last 3 payments. Or for rehab loans, where the guy's just finished rehabbing the property, you can get the new lease with the first month's deposit and first month's payment, and we'll take that. So that's another great way to go. And don't forget about, if you're in an area with a very low cap rate, meaning the rents cannot get you over a 0.7 DSCR, or maybe you don't want a rate because the rate is a little bit higher as the DSCR drops, you can use either full or alt doc. And the alt doc is, just 12 months bank statements, business or personal, and we're just looking for a 50 DTI on it. So that's another way to go, and you get a much better rate that way. Okay, Albert, ready for the next one. Okay, short-term rental, and we're looking at a loan we recently closed in the Florida Keys on the water. Nice property. We've got a payment of $5,400, and we used AirDNA. So in the AirDNA is a great way to go on a purchase. You still apply the 20% expense ratio, and on the AirDNA itself, we just look for an occupancy rate of 65 and a market score of 60. So this usually on a purchase will work in high density areas with a lot of rentals. If you got a rural property and it's seasonal, it's not going to work as well. But we have other alternatives. We can use market rents again out of the appraisal, or we can get, if it's an existing rental property, just a 12-month look back and from a professionally run company, or we can use the borrower's bank statements showing the short-term deposits coming in and the records. It may be their personal records in that case, but we can demonstrate the income. So that's another great way to go. Love this one though. Okay, Albert, next one. Okay, another recent example, condotel. So basically you're looking at a property that is run like a hotel or motel. So they could have daily rates, they could have weekly rates, or longer, but it's usually in a resort area. And basically the investor concentration can be 100%. So they could be all investor units. The minimum square footage on these is 500. It does need a full kitchen with appliances. And I mean, a stove and a refrigerator, everything. We can't just use a hot plate and a microwave. And also it does require 1 bedroom, but this one looks great. Salt Lake City, 75 LTV, second home, and basically a very quick close. And it's a great brand new property. So probably a ski resort. All right, David, back to
All
you.
right, thanks, Art. There's some good
You're welcome.
examples of loans that you might not say, hey, can we get them done? I do want to highlight some red flags. These are kind of say is what loans kind of that you kind of be aware of. And I don't say no to these, but it's better to know up front, right? The DSCR business purchase not to be used to circumvent TRID loans, right? So these are non-owner occupied business purpose only. Now, some of the loans that come in, we can do some loans that have been listed on the MOPA market and now they decide to keep. But keep in mind, it's listed for sale, especially if that's a builder loan. They're probably their intent is, say, they need to sell it and couldn't, right? So just be careful of some of these types of loans, right? Rapid value increases in the last 12 months without really much improvement. So we're not going to say no. We're going to have to look at that and have a little bit different reviews on those. So I want to be upfront with you. And then additional items to look at. ADUs are big, especially in California. Really, the question is it permitted? Then you could use as additional rents. Unpermitted additions are a little bit tougher to use. And again, everybody asks me, well, how do you look at property? It's the marketability of the property. How marketable is it? And is it legal, right? And if you have those two things and understand that, you usually are okay. Also be careful of vacant properties, right? Those are things that we need to look at, especially on a refinance. Vacant property, perfectly okay on purchase. We understand that. And also, it just got rehabbed. They bought it, 2 months ago. They rehabbed it. Now it's marketed for a tenant. Those are the ones that generally are okay. But if it's been vacant for a long time, those are difficult, right? To get done on a refinance. So with that, Albert, I think we'll be open up for some questions here after we look at the matrix here, right? So for those that are signed up with us, you can log into your portal, you can pull up rate sheets, the matrix, but this is just to give those that maybe just want to look at it, that haven't been on our portal. And if you want access to that, you're going to have my contact information here and we'll get you set up. You don't have to be approved with us to get access to that, but you do need that. We need to give you some credentials for our portal. But we go up to 80% on DSCR and income docs, right? That's for both purchase and cash out refinances. Again, the score's got to be a little better credit profile, and DSCR needs to be over 1 for those. But even at the no DSCR, what we mean by no DSCR, that means it's lower than 0.75. That we still have loans all the way up to 70% LTV on those. So some great opportunities, hopefully for you on this. You kind of look at it, kind of discover this. Then really put it in as you start thinking about, I got holidays, but it's kind of plant the seed here for 2025. How can we capture? Again, when I was talking to Albert as we started the webinar, in 2024, it's estimated to be about just short of 1.8 trillion. 2025 is 2.3 trillion. I think this is going to be a pretty big percent growth here for that. And we'd love to see you capitalize that and be your partners with that. So with that, Albert, I think we can, go and take some questions here.
Yeah, I agree, Mr. Grider. I think we should. So we did have one from Lisa Gafikin. I hope I'm saying the name correctly. And it's, what is the LTV restriction on a 0.9 ratio? And we just talked about it, right?
It's -5. And you'll see that on the matrix as well, right? So if you're under 1, the max LTV is 75 on that.
Okay. And then from Lisa as well, she said, do all DSCR programs have a prepayment penalty term?
No. I'm glad this is a great question, right? We do have options for no prepayment penalty all the way up to 5 years and a tiered function one as well, because we do know borrowers have different needs with that particular product. If you go to a no prepay, again, we're not to be used as a bridge loan, right? So normally there's at least a point cost or 2-point cost that we're getting that, because we know that they're most likely going to pay that off, sell it, or refinance that after they do certain things. But there's options, all the prepay options for you from 0 all the way up to 5 years. You go, well, why would someone want 5 years? Well, you get a better rate. And there's a lot of times they'll take that 5 year because they know that, hey, I'm going to hold on to it. The loan's great. It's going to have cash flow. I'm not doing anything. It's here for a buy and hold. And so we have all those options available for you.
Perfect. Thank you. Randy Damgar, who's one of our AEs, said he put in lease, pool, and recreational area. It looks
So
like that was
this one has to do with non-warrantable condos, which is on there, right? And so when you look at leasehold properties, that portion of the this is probably on a condo, right? If he's talking about rec areas, right? It's not a typical thing. So we're talking about a condo that's got leasehold, a portion of it. And so if a portion of it is leasehold and it is a rec area, we can look at those. Absolutely, we can.
perfect. And then he did also write an additional comment. He said if he can call you to chat about a deal.
Absolutely.
Awesome. Thank you for that, Mr. Grider. Ronice Saron put in, thank you for the webinar today. Can you please email us the video? Great information.
Video, yes. Yeah. Do we email the video, Albert? I know we email the deck, and we do record this. And where can they find some these training videos, Albert? Maybe that'd be good for them.
So we can make this available. We can make the video presentation available to them. I will work on that with marketing and with Gina.
Right. Okay. But there's other marketing material on webinars, I think, on YouTube, on our YouTube channel.
On YouTube and on the web, on our website.
And our website as well.
Right. But the YouTube channel, definitely the video does get posted on there, as a matter of fact. Okay, so we're getting some traction with the questions. Here we go. So the next one, I'm just going to go in the order that they are received, by the way. If the current rent received is a long-term lease and maybe less than current market rent, would you require we use the lease rent amount or the appraisal average rent figures?
That is a great question. We give you the option, right? So when we see the 1007 comes in, even on a refinance, we can just go by the market rents on the 1007. So if the lease is more, you probably want to provide that. If the lease is slightly less, we're just, don't provide that. Just order the 1007. That's what I say is, like, when I look at these loans, normally we already know the credit profile, right? Hey, it's got good credit, pays their mortgage on time. There's none of that stuff. What's it really come down to is that appraisal, the property and the cash flow. And that's where it looks at. So what you need to do is kind of figure out where that is at. And that's where your account executive is going to work with you, because I see, we're all kind of submitting these loans and, okay, hey, I think it's going to be 1-to-1. You really don't know until you get that market rents, unless you're going income docs, because that's not it. It's an income file, right? So you're going to know what it is. Or you already have the actual rents that it covers it, so you already know that. And so a lot of times it's you're looking at, how do I make this work? So you can actually qualify in interest only. I've seen that, right? Where, hey, I'm going to switch it interest only to get the DSCR, because we're going to calculate it with that payment. Right? It's not a fully amped calculation. Like, if you're doing a consumer purpose loan under Dodd-Frank, you have to do the fully amped payment. But we qualify on the actual payment, which would be the interest only payment. Also, I've seen stuff that, hey, if they want 70, 75 or whatever that LTV is, kind of below our max, we're able to finance some of that points or that to buy down the rate to make that deal work. That's why there's a lot of ways to structure loans. So when you say loan, just don't give up and you're looking at it. Reach out to us and we'll help you structure that loan.
Awesome. Thank you for that. Ronice just said much appreciated about the video, so you're welcome. We do have a question from Patrick, and it says, can you provide current day pricing example, 80% LTV business purpose of an SFR?
Wow. I can, when I'm on the portal pricing. Again, we're forward facing. So you can go into our portal 24/7 and price any scenario you want. Right. And again, pricing does change. We saw where the 10-year and 2-year kind of rose yesterday significantly. Right. That's what we're at today. Then it looks like we're rebounding back a little bit today. And it's kind of like this fluctuation with the elections going on and people probably moving money and, back and forth. So when I provide that, we do have that rate sheets, and we actually have a quick pricer on our website, Albert. So they can do that. You can just do a quick pricer on your scenario. there on our website, and it'll tell you, you have access to that 24/7. We're also on Lender Price, right? So you can actually go onto that as well.
That is correct.
So if you're looking at this now, I'm on Zoom with webinar. I can't exit this and go into the portal to go ahead and price the deal. But if you give me your contact information, I can have an AE get that information over to you. And probably the rate sheets as well if you want to look at that. But I always recommend go to the portal, right? That's the best way to get the most accurate pricing.
Yeah, that was Patrick Lavore that asked the question. So we'll have someone reach out to Patrick. Next question comes from Mark Hill, and it says, what is the percentage penalty for the prepayment penalty?
Okay, so we go with a 5% hard traditionally. Now we do have a tiered prepayment option. That's what we have that. So, so if you went with a 5-year tiered, it starts out at 5, then 4, then 3, then 2, then 1, and that's a popular one, right? Because they know, hey, if I'm looking at rates, and this is a good point, right? I'm looking at rates through 2027. You know what? It's flat. MBA's forecasting rates to be 6% in 2025 all the way through 2027, right? So if you look at our standard pricing is at 3 years, probably makes sense because then after 3 years it drops to 0, or maybe some say, hey, I might keep it longer so you can do the tiered. So the first year would be 5, then the next year 4, and it goes down after 2.5 or years or so. It's beneficial to go that way. You don't know where that is, right? And then you have options to go to 1 year or 2 year.
Awesome. The next question is from Phil Dunk. Oh, Phil was just putting in the link to our past webinars. Thank you, Phil, for putting that in there. The next question comes from Zeke Sholmi, and it says, do you require 1007 for a short-term rental unit?
Yes. That question is right. However, we may not use it because sometimes you'll get the 1007. It's on long-term rents, but you want to qualify to short-term rentals. So no matter what you do, if we're doing a loan on investment property, they all require a rent survey. Well, and I get these questions, well, I don't need it for income qualification because they make enough money. I get all that, but it has to do with the marketability of that particular property and for the secondary market of how they look at it. So even if we're not using that because we're using income, we still need it as a piece of this appraisal collateral piece on the marketability of it. So that's where that's required, even though we may not need it at all, right, for that particular loan as far as qualifying on DTI or those type of things. So it doesn't necessarily mean we're qualifying off of that, but we still would need a rent survey.
Thank you for that, Mr. Grider. I think this is a very good question that we've been asked, and it's how quickly can I close a DSCR loan?
Well, how fast can you get us an appraisal so we can work out with you? And how many COCs you're going to do, right? So these can be done pretty quick, and I've seen them in 5-6 days. And the reason I say 5-6 days or in the docu is because I already have the appraisal, they already have all the documents uploaded, and it's underwriting, and you're done. And so those cases goes quick, but most of the time it is, submission. We're just waiting for the appraisal with the rent survey, and then to kind of massage the loan a little bit for what the borrower wants to accept based on that DSCR, LTV, cash down or money out. And so we're messing with it on a COC basis. Maybe you're not locking your loan, so that's another day on, hey, I got to lock the loan, so I got to do COC or some type of disclosure out that we're locking the loan. Again, it's not required since a business purpose to do it, but we go through a system, make sure everybody's on the same page. It's at the rate that's requested and the program that's requested.
Awesome. And then we do have a follow-up to the prepayment penalty question. It says, so the prepayment penalty is 5% off loan amount?
Yeah, off the outstanding balance, whatever the unpaid balance is, right? Then you pay it down as 5% hard. Anything above the payment.
The payment required, right? Yeah.
Mm-hmm.
Okay. So far that has been the main questions. I did have another good one here, and it's with regards to DSCR, can cash out be used towards reserves, Mr. Grider?
Cash out, yes, it can. On a refinance, you can use cash out for reserves.
Perfect. Thank you. And then I think as one of the final questions that we have is, do you have a limit on the number of properties you will lend on?
Well, yes, for one particular borrower, the maximum limit is 10. Right, up to an aggregate of 4 million at one time, right? So again, it's just a risk level tolerance as you go into a pool, how many loans you have on there at one particular time. And so if you have a borrower that's got 40 properties and they're coming up, they're on, you know, some private party deals at 10, 12%, and they need to take care of those. Yeah, we can do it. We can do 10 at a time for that particular borrower. Then have to wait a few months and you can bring in some more. And you can get with your account executive. We kind of give you the timing on that. But doing 10 at a time is going to take a little while because you're trying to match them up. A lot of times I see blanket loans where they purchased properties maybe a year or two ago, and they went private money where they did a blanket loan. Then we're have to do them all at the same time to pay off that blanket loan.
Awesome, thank you. Manuel Gonzalez has asked in the chat, gifts, question mark?
Yeah, he's probably talking about gift funds. Yes, those are acceptable. Get with your account executive for the amount that the borrower has put in. The rest can be gifts.
Awesome.
But yes.
Zeke has asked a question. An investor FICO is 630. He has a partner with a 700 FICO on the LLC operating agreement. Can you help with a DSCR?
Yes. Now we're going to ask a little bit about the percentage of ownership of that LLC, that business entity. But yes, there's ways to get that done for you. So those are going to be very specific, and that's where we kind of tie you with one of our account executives to look at that and how to structure that in based on what you have. But our minimum FICO is 620 anyway, right? So you could have a lot of avenues on that.
Awesome. This has been some really great questions that
we've
been getting in the chat. With that, Mr. Grad, I don't see any more questions popping up. I don't know if you have any final closing words, sir, so we can.
Well, I just want to say thank you for everybody that attended and all our partners out there. I can't appreciate enough. This has been a great year in the non-QM, even though the mortgage industry is kind of like, it has its volatility, and I understand it. I've been doing this a long time in this industry, and I've seen it go up and down, and it's just part of a cycle, right? And I think we're going to turn into a pretty good cycle in the next 2-3 years, not in the refinances, but I think people have been sitting on the sidelines for a long time. They're going, hey, the market is what it is. If I need to make a move, I need to buy that house, I need to refinance, they're going to do that. So I'm expecting volume, just like MBA does too, is going to keep increasing through the next several years. I'm optimistic, and maybe I'm a glass half full type of person, right? And then please enjoy the holidays. We're not going to have a webinar next month to close out because we got so many things going on, but the next webinar is going to be on 2025, and really how does that look, right? So I'm going to do a little bit deeper dive into the non-QM products and how that's going to look in 2025. So I hope you guys all attend. And again, my contact information is there. I try to get back with everybody right away, but sometimes it might be an hour or two, just the volume of calls and emails that I have, but I will respond to you. Please just email me anytime.
Thank you, Mr. Greider. And it looks like Lisa, she says that she has an offer on the table today with DSCR and is looking forward to closing it. So we
awesome.
Awesome.
I love it.
Yeah. Awesome. We'd love to partner up and get that close. And then Zeke just has some final commentary, and it says, let's see what the Fed has to say in 20 minutes.
Yeah, no, I got that too, and I agree with you. And I think it's already built in a quarter. So that's my bet. There's a pull here. I think it's a quarter lower. I don't think it affects mortgage rates that much, though. That's the thing. There's other factors in the Fed move, but I'm hoping it goes lower over time, and we can balance this inflation with jobs and get our economy in the right direction. I'm optimistic there as well.
Awesome. And Mr. Hickson, do you have any final closing words, sir?
No, I just wanted to thank everyone for joining us today. I think it was a great presentation on what can be done with business purpose loans.
Awesome. Well, thank you everyone for attending. And then a copy of this will be sent out, and it is actually posted on our website as well. So we'll see you next year. Have a good one, everyone. Happy holidays. Thank you.